Okay, part 3 of chapter 3. So let's finish this up. So where we're at the end of the accounting cycle. We have gone through, we've recorded transactions, we've made adjustments, we've prepared trial balances, we've prepared financial statements. Last thing left, if you look at those 5 steps in the accounting cycle, the last thing left is to do what's called closing accounts. And once we do that, we're done and we're ready to start up again the next period. So what we got to keep in mind is there's 2 kinds of accounts in the world. There are permanent accounts and there are temporary accounts. Permanent accounts are things that we want to carry the balance forward to the next period. So these are things that will be there at the end of December. They'll be there at the beginning of January. So what these are things on the balance sheet. Assets, liabilities, and equity will still be there on January 1st. If we have $10,000 of cash in the bank at the end of December, we'll have $10,000 in the bank at the beginning of January. So these are accounts that do not get closed. Permanent accounts don't get closed. We don't do anything with them when we go through the closing process. We just take the balance that we had at the end of the period, at the end of December. That balance gets carried forward into the beginning of January. What we're concerned with here are temporary accounts. Temporary accounts are accounts that are used to keep track of something for some period of time. Once we get to the end of the period, we do something with the information, and then we want to start over again the following accounting period. So what's included here are the income statement accounts and dividends. So revenues are temporary, expenses are temporary, and dividends are temporary. Income summary technically is temporary, but we're not going to use that account. I think it's a dumb way to do the closing process, so we're just going to skip it and not use it. So basically what we're left with is the income statement, which is revenues and expenses, plus dividends need to be closed. What we mean by closing is we're going to zero the balance out and put the balance somewhere else. Okay, so what we're doing, remember the goal here is make the balance in the account 0 when we're done. So we can start over again and do the same thing next period. We can figure out how much revenue we have in January. We can figure out how many expenses we have in January. What we do is these balances don't just get zeroed out and they're gone. We're going to transfer them somewhere else. Where we're going to transfer them to is retained earnings, which is a permanent account because it's on the balance sheet. It's in the equity section. And what we're going to do parallels what we've talked about before. Revenues make retained earnings bigger. Expenses and dividends make retained earnings smaller. So what we're going to do is we're going to close the accounts out. We're going to make retained earnings bigger to the extent we have revenues. We're going to make retained earnings smaller to the extent that we have expenses and dividends. So here's what we're going to do. So what this is, these are amounts for Mike Spikes. If we go back to the income statement, let's go back and look at the income statement for a second and see what we have in the way of revenues and expenses. So if we look at their income statement, we see that Mike Spikes had $12,200 of revenue. They had 5 different expenses: cost of goods sold, wages, rent, depreciation, and interest expense. In total, they added up to $4,350 of expenses. So what we need to do is to zero all of these accounts out and put them into retained earnings. The way that we're going to do that, it's a very mechanical process. No thinking required in terms of what gets debited, what gets credited. It's always done exactly the same way. With sales revenue, our goal is to zero out the sales revenue account. So the sales revenue account has $12,200 in it at the end of December. If you remember back to our discussion in Chapter 2, the normal balance of a revenue account is a credit balance. So if we want to zero that account out, we're going to debit it for $12,200. It has a credit balance of $12,200. So if we debit that account for $12,200, we make the balance 0. Whatever we do to sales revenue, we do the opposite to retained earnings. So if we debit sales revenue $12,200, we credit sales revenue or retained earnings $12,200. Remember that retained earnings is an equity account. Equity accounts normally have a credit balance. So when we credit retained earnings, we make retained earnings bigger. Not surprisingly, expenses, we do exactly the opposite. Expenses normally have a debit balance. So what we do is we look and see how much do we have in each one of our expense accounts, and we credit that expense account for the same amount and make the balance go to zero at the end of the period. We add these up. In total, they add up to $4,350. Since we're crediting the expense accounts, we debit retained earnings. Retained earnings is decreased when it's debited, so we decrease retained earnings for the amount of the expenses, which in this case total up to be $4,350. Worth noting here that if we had any dividends, we don't, but if Mike's Bikes had paid dividends, the closing entry would be a credit to dividends to close out the dividend account and a debit to retained earnings to decrease retained earnings for the amount of the dividends. Once we do that, we are one step away from being finished. Last thing we need to do after we do the closing entries is we prepare a post-closing trial balance. And this is just to make sure that we've done the closing process properly and to give us the balances we need to start over again on January 1st of 2020. So what we're left with are all the permanent accounts that we didn't close, still have balances. And if you go back and look at the adjusted trial balance, these are the same balances that were listed there. So we just have chopped off the trial balance after retained earnings. All the revenues and expenses have been closed, so we don't list those out. Those all have balances of zero. Here's the things that still have balances. And if we've done everything correctly, retained earnings should now have a balance. Remember, in the adjusted trial balance, it had a balance of zero because it was a new company. After closing revenues and expenses to retained earnings, the balance is now $7,850. Where that $7,850 comes from, $12,200 minus $4,350. That gets us to our credit balance and retained earnings of $7,850. Because remember our rule with debits and credits when you combine them, when you combine a credit balance of $12,200 with a debit of $4,350, you subtract the smaller one from the bigger one, and you end up with a credit balance of $7,850. And then we just roll this into the next period. We just start operations in January. Here's the balances we start out with in January. Revenue and expense accounts start with a balance of zero. As we earn revenues and incur expenses, those balances will go up in January again. And if January comes around, we'll close those out and we'll start over again in February. All right, multiple choice question related to closing. Which of the following is a true statement regarding the closing process? And basically, what are we doing with dividends, revenues, expenses, or dividends? And we will discuss when we meet next time. Okay, last thing, or second to the last thing here is quality of earnings, or quality of accounting numbers. So accounting professors, in addition to teaching, do accounting research. And one of the things that accounting researchers are especially interested in is what impact accounting information has on stock markets. And a term that's been coined as quality of accounting information or quality of earnings is another way to express it. But what we're saying is how good is the information that's in the financial statements? And what we're trying to get at is how good of a job do the financial statements do in representing the company's actual financial condition? Are the numbers unbiased and they give you a good indication of what the company's doing? Or are the numbers being fudged, being shaded, trying to make the company look better than it really is? What's the company doing? And you might think that accounting, the common perception of accounting is it's very black and white. There's right ways to do things and wrong ways to do things, and things are absolutely right or they're not right. In reality, there's a lot of estimates and judgments that go into financial accounting. So what that means is there's a lot of gray area. Management has some discretion in how they record things. And what we mean by quality of numbers is that when management makes estimates and judgments, they're making their best guess. They're not trying to make things look better or worse than they really are. They're just trying to express what's my best guess at what this thing is. They may be right, they may be wrong, but if they're being honest about it, sometimes they guess too high, sometimes they guess too low, but on average, they tend to be correct or pretty close to it. So when people judge accounting numbers, they look and see how good, high quality the estimates are, the judgments are, and how well the company's numbers represent the company. And in general, the more conservative a company is, so in other words, they're not trying to stretch the truth and make the company look better than it really is, that when companies are conservative, or if they at least tend to be accurate, quality of earnings is judged to be higher. And the payoff to the company is that companies that are judged to have high quality earnings and high quality accounting numbers tend to have higher stock prices than companies that are judged to stretch the truth, be aggressive with their accounting, try to make the company look better than they really are. So rewarded with stock price if you're honest with your numbers. There's always a temptation to try to make things look better than they really are, but research is pretty clear and unequivocal that when you try to do that, in the end you end up getting punished by stock markets. Okay, last thing, we're not going to get into this in detail because chapter 3 is long enough and confusing enough without throwing this in there on top of it. If you go on to be an accounting major and you take intermediate accounting, you'll get to learn how to do this, but we'll just pass by this for now. But that's a worksheet. So you've actually seen part of a worksheet. Worksheets are often done in something like Excel, and it just takes all the stuff we did in chapter 3 and puts it into one big spreadsheet. So instead of having these independent pieces, you put it all in one place. You have the unadjusted trial balance, you post your adjustments in some more columns, then you have an adjusted trial balance that's a result of the unadjusted balance combined with the adjustments. Then we prepare a set of financial statements, and then we have a post-closing trial balance displayed as well. So you could do one, it just combines a lot of the stuff we did in chapter 3, but we're going to skip by that for now. So not holding you responsible for being able to prepare one of those, even though they show you how to do it in the chapter. Okay, that's it for chapter 3. Again, quite a bit of information to digest here. Doing some problems, getting some practice will be key to understanding this stuff. I will go over some problems with you next time we meet. And as always, if you have any questions, make sure you contact me sooner rather than later to get the questions answered, and I'll be happy to help.